Are you a small business owner that still struggles to understand how your business income is taxed? Well, stay tuned to this video. In just a few minutes, we'll run through some of those tax fundamentals so that you can understand how your business income affects you from a tax perspective. Hey everyone, it's Anthony from Essentage, Tucson's premier accounting firm. As I mentioned in the intro, we're going to spend just a few minutes today talking about some of those fundamentals to help you understand how your business income affects you as a business owner from a tax perspective. Now, the content in this video is relevant whether you're a sole proprietor, you own and manage a limited liability company or an LLC, or you're organized as an S corporation. I'm going to turn it over. Sal's going to step in, walk you through some of these fundamentals and specifics, and we're going to tie everything together and wrap up.
Hey everyone, so as Anthony mentioned, if you own a small business and you're an LLC or an S corp or a sole proprietor, it turns out that all of your business income will flow through to your personal tax return. So as everyone knows, your personal tax return is your 1040 tax return. So what will happen is, because those entity structures are really pass-through entities, all of the profits from your business are going to pass through to your personal tax return. Now, on your personal tax return, there are different schedules or forms that need to get filled out with respect to your business income and expenses, and it's really based on the structure of your business and how things are set up. But ultimately, really what to remember and what to know is that your business income will flow through to your personal tax return. Now, once your profit from your business is determined and it's on your 1040 tax return, you do actually get what is called a qualified business income deduction. So that deduction is actually new under the new tax law. Now, once your accountant or your tax preparer has determined what that particular deduction is, it does reduce your business profits from a taxable standpoint. Now, once you've figured out the profits from your business and you've taken your qualified business income deduction, what's left will be taxed for income tax purposes. So this is where traditionally you'll be assessed income tax on the profits from your business. But hold on, there's another type of tax that will also be assessed. That tax is called self-employment tax. Because you own your own business and you're not employed by, a company or you don't have an employer, you are now subject to what is called self-employment tax. So you're asking yourself, what is self-employment tax? Well, self-employment tax, another term for that is FICA taxes, or even a better explanation is it's Social Security and Medicare tax. So the profits from your business after you take your qualified business income deduction are going to get assessed for income tax and are going to get assessed for self-employment tax. And self-employment tax runs at a 15.3% rate. So basically you're going to take those profits, multiply it by 15.3%, and then that really is going to determine what your self-employment tax liability will be. So now that you know what the profits from your business are, we need to assess income tax. But hold on. There are other elements that need to be figured out before you can do a final taxable income amount in order to figure out ultimately what your tax liability may be. Those other elements are really the personal elements of your tax situation. So in other words, are you married? Are you single? Do you have children or any other dependents? Because all of those factors play into how much income tax you will ultimately be paying once you've determined all of your personal items with respect to whether you're married or single or you have dependents. Now you could bring into your tax return, any other income that you may have. Say you did work part of the year and you have a W-2, or say you're married and your spouse has a W-2. So you'll need to include all that income on your tax return as well. Once you have that information input onto the tax return, then you can come up with your total taxable income. Now you need to look to what is called the tax income brackets. So there's where you're going to have all the income tax rates. And the rates are bracketed, but what I'm going to do is I'm going to have Anthony walk you through those brackets.
So as Sal mentioned, that element of understanding what tax brackets are and how they work is really important. I'm going to give you an example. I'll use the example of kind of like a single filer, a single person, unmarried. So let's say, as Sal mentioned, you've got total taxable income figured out, and now you need to determine what brackets are applicable and how does this all work. And I'll use kind of round numbers or approximations to explain these brackets. So if you're a single filer, again, unmarried, your first $0 to $10,000 approximately is going to be taxed at 10%, okay? $10,001 through roughly $40,000 is going to be taxed at 12%. And then the next chunk, $40,001 through approximately $85,000 gets taxed at 22%. So again, I'm just throwing out this example to illustrate all of the income is not taxed at one rate. Chunks of income are taxed at different rates, and of course these rates tend to escalate the more taxable income you have or the more money you make. So in light of everything we've talked about, I'm going to share with you a little tip. This is something we do with our clients that we work with every month. Not only do we do their books, but we're constantly looking at their income levels. We're advising them on what the applicable taxes are using those specifics or those elements that we talked about in this video. And then we have them set that money aside on a monthly basis, either in a savings account or some other account where they can set that money aside, earmark it for taxes, and either remit it quarterly or have it ready for the end of the year so that there's kind of no surprises, tax money set aside, ready to go. Because as we all know, Uncle Sam wants his tax money one way or the other come the end of your fiscal year. And it's better to prepare in advance rather than be scrambling at the last minute. Going forward, what we'll do is we'll produce more content and put out more content. It'll probably be in the form of a podcast where we'll talk about some more advanced strategies in terms of preparing for, your tax situation as a business owner. So definitely stay tuned for that. We'll dive in a little bit deeper on all of these elements. So as always, feel free, questions and comments, leave them in the area below. If you haven't done so before, please subscribe to our YouTube channel. And until next time, we're wishing all the small business owners out there success and hoping everyone in general is staying safe and healthy. This is Anthony from Essentage signing off.